July 12th, 2024. Today was pretty much a pretty large bull trend day until the end of the day. And when this happens, you probably got to be wondering why did we get the big sell-off at the end of the day? And I think it was mostly due to the daily chart. If you look at the daily chart, I thought that I had mentioned yesterday that I thought this was probably going to be the start of some sort of trading range, and that even if we went up, there probably wouldn't be much more to the upside. It was good for the bulls that we were not able to get below yesterday's low, but ultimately this bar still exists and it's a bad high one for the bulls buying above. So even though it was a big bull trend day from the open, we ended up getting, I'm going to turn this study on real quick. We ended up finding sellers up here because this was yesterday's high and this was a big bear bar on the daily chart. So it wasn't smart for bears on the daily chart. Sorry, it was not smart for bulls on the daily chart to buy above here. Therefore, there ended up being more sellers above and we ended up getting a sell-off down. I thought it was possible. Well, coming into the day, I was pretty aware of the open of the week right here, since it was basically the bottom of this trading range. This was the open of the week. So I thought we were going to oscillate around this area. And if we got a trading range day, traders would end up fighting over the open of the week, as they often do. This was clearly not the case here, as we got a big bull trend day, but we ended up reversing back down towards the end of the day. Was this a logical target for the bears? Not really. It was too far. But had we started a reversal down from here and gotten some sort of lower high, then again, it still would have been a pretty big sell-off, but this would have made more sense. But I think the bulls just did too much damage to the bear case. So coming into the day, you know that we've been in a trading range, right? Yes, this was a bear trend from the open, but for me, this is the end of the trend when this channel starts and this fails. I think it's reasonable to argue it was somewhere in here where the trend ended. But for me, I think I see these bars, I see this as the start of the channel, and it was near the important magnet of yesterday's low. So to me, I look at the trading range started at bar 24. So coming into the day, we've been in a trading range for 59 bars. When you've been in a trading range for 59 bars, it's better to wait for the breakout than it is to bet on any particular breakout before it happens. So reasonable, if we get a breakout to the upside, which we ended up doing, you want to go for a measured move up the height of the trading range. And if we got a breakout I don't know if that's where this went to. It's pretty close. So it's obvious that this was the first target, the measured move up of this. And then if we break out to the downside, you want to get a measured move down, again, the same height, ending up somewhere down here. So coming into the day, traders know we're in a trading range and they just basically want to wait and see what happens. Bar 1 is a doji bar on the open. In general, doji bars increase the odds of a trading range day instead of a trend day. Obviously, that was not the case today. I don't know. Just look at a couple of them. Essentially a doji, mostly a trading range. Doji, weak bull channel, more of a trending trading range. Trading range, and then we have today. So not quite a trading range. This was a real doji and ended up being a trending trading range day. Obviously, trending trading range days, you go sideways and then you get a 4 or 5 bar breakout and then you go sideways, basically touching back towards the upper range. This pulled back a little further than a lot of trending trading ranges do. A lot of the time, you'll get sideways and then a breakout, and the high of the first range will essentially become the low of the second range. But this is a pretty good example of a trending trading range day. So bar 1, a doji bar, increases the odds of an overall trading range day. Again, we've been in a trading range for almost 60 bars at this point. So it makes a lot of sense to just wait and see what we get as a breakout. Bar 2 was an inside bar. Zoom in a little bit. Past day and a half. Bar 2 was an inside bar. A bull bar it was an inside bar for most of the bar. But if you were watching in the last minute or so, it traded above bar 1 and then sold off a little bit. And what does that tell you? It tells you that the traders who are, it's disappointing. Bulls wanted to see an inside bar and a credible buy. If you've seen my slideshow on inside bars to start the day, sometimes they do end up being the high or the low of the day. It's not all that high probability. Even if 2 closed on its high right here, you're still buying high in a trading range. But even if it's only a 30% chance that it's the low of the day, a lot of algorithms will take that because they're only risking 5 or 6 points and they're trying to make 30 to 40 points. So the math makes sense for them. Here, it ends up not being an inside bar and we end up trading above, which makes bar 1 the signal bar and bar 2 the entry bar, which is disappointing. Coming into the day, even though, we're in this trading range, I was not going to be surprised if we went up a little bit towards the bar 19 low and then started a trading range up here. Why the bar 19 low? Because here, some bulls may have bought below bar 19 thinking 20 was really strong and thinking this was going to end up being a trading range. And those traders are scaling in. And they're probably going to be able to get out around break even or on their first entry and with a profit on their scale in. So I thought most likely we were going to end up going back to here, which that was honestly my problem with selling bar three. Was I thought this magnet, the 19 low, was going to be pretty important, and we were probably going to have to get back to it. So bar three, I don't know, potential high of the day. If you wanted to, you could sell and take a chance we break below yesterday's low and get a collapse, but it's not really all that likely that it's going to happen. Maybe only 25, maybe 30% chance, I would say, that bar three ends up being the high of the day when we get some sort of bear trend from the open, probably converting into a trading range. Problem, in general with selling this is that you're probably going to end up getting trapped out, even if it is a bear trend day, because this is a big trading range and we have to get through all of this. If we're going to go down here, break below here, we have to get through all of this trading range price action, which is going to be pretty difficult for the market to do. So in general, probably better to just wait and see what we get. Bar four, an outside up bar closing near its high. So bar four is kind of, for me, when I look at these kind of bars, I thought the context was better for it than usual, because bar four, the big thing it has going for it is it's closing above the past 61 bars. So that's the really important thing about bar four. For me, the problem with bar four is it's a really big bar, and so the risk is going to be kind of big. And so some traders might be hesitant to buy. If you are buying, you're betting we're gonna, at least get back to here, but that's not enough. You can't buy and try to scalp for less than a point. Then another problem is that you're buying right at the bar 19 low, where there might be traders who are selling the breakout point from yesterday. So big bar, so big risk, and you're around this low. But if you're buying, you're basically betting we're going to retrace the entire bear channel. This was the spike from bars 8, 9, 10, and 11. And then the channel started at the high of bar 13. So some bulls will buy, and they know it's a big bar, and they know their risk is 8 or 9 points, but they're betting that we've seen the low of the day, and they're okay with risking 8 or 9. Maybe they have a stop below the low of the day, maybe 10 points, and they're trying to make, a little over, so whatever, 23, 24 points. So you still have pretty good risk reward doing so. And the fact that bar four closed above the where the past 65 bars have closed is also pretty strong for the bulls. It increases the chances that we're going to get a bit of a rally over the course of the next couple of bars. Bar five, consecutive bull bars closing near their highs. It's good for the bulls, but the shrinking body size is definitely a bit disappointing. Sometimes, the market you'll get a big bear bar after this because bulls will just dump out of their longs, especially, let's say you bought above four. So one of the reasons four is a tricky trade is because traders who buy above it, sometimes if you get a doji bar that looks like, like bar 12, like if bar 5 had looked the way bar 12 does, sometimes what will happen is bulls will just dump out of their longs and you get a pretty big bear bar, and it'll retrace back down to maybe the bar 3 low, where any bear who sold and scaled in might be able to make money. And that would force a trading range open. So if you're buying here, you're kind of betting on a bull trend from the open, which is it's a difficult thing to bet on because usually you don't get trends from the open. Usually the market goes relatively sideways. So a lot of times I end up missing trends from the open, like I did today, because I just try not to bet on trends from the open because the market's usually trading range open. So I usually hesitate when setups like this come. 6, more follow through for the bulls, a big tail on the top and a big tail on the bottom. We have 3 straight bull bars. So in general, 60% chance we're going to go somewhere up here before we get back down to here. But good for the bulls. No end in sight. Clearly getting a breakout above this. And I would say pretty likely at this point that we're going up to this high, the measured move up. So I think pretty likely that we're going to get up into this area. 3 straight bull bars. It is by the close. Probably easier to buy above 4 or 5 than it was to buy above 6 because of the tails on both sides. 7, a big tail on the top and a big tail on the bottom as well. We're probably going at least a little bit higher, but I don't know. This doesn't really look very ideal, to be honest, at the point of 6 and 7. This was a surprise. This is pretty unusual. Once you start to do this, you usually start to go maybe a little bit more up, but then you start to go sideways before you get a second leg up. And instead, we got a spike. Usually you get spike, pullback, and then channel, or spike, and then, this, obviously, this is a lot stronger than this. The bulls have more bars here, but you can just see how much larger the bear bar is here. So this ends up leading to a spike in channel. And oftentimes this can also lead to a spike in channel, but sometimes it might have to go a little bit more sideways first. It's unusual for it to do spike, pullback, stronger spike. That's less common. Because just logically, if the bulls were only willing to buy and make the bars look like this at these prices, why would they be making bars look stronger at higher prices? So it's less common for that to happen. 8, another bull bar. So now we have 5 straight bull bars, 4, 5, 6, 7, 8. So 5 straight bull bars with reasonably strong closes on the first 2. And although, 6, 7, and 8 aren't closing near their highs, they're still pretty big bars. And it's clear that we're going to end up going higher. We might have to pull back first, but it's pretty clear to, I think, most traders that we're going to end up getting some sort of second leg up from this. 9, more follow through for the bulls. So again, 4, 5, 6, 7, 8, 9, a lot of straight bull bars, and we haven't been below the moving average yet today, which is pretty important. Traders, a lot of traders will hope that we pull back the moving average at this point so that they can buy lower. But a lot of times when everybody's hoping to get a pullback, it never really comes. You have an inside bar on bar 10. It's a high 1 for the bulls. It's a possible final flag. And you can see we never ended up trading above it on bar 11. We ended up instead triggering below it. When you trade below bar 10 on bar 11, you got to think like 80+% chance that there's going to be buyers below 10. There's no reason to sell below 10 pretty much ever. I think there's obviously algorithms doing everything at any time. I'm sure on some other time frame, there's some sort of parabolic wedge that's being created by bar 10 so that bears can sell it. But the reality is this is such a strong, tight channel that there's no reason for an individual trader to ever sell below 10. Really, this tail here is just bulls taking profits. So I think it's bulls selling out of their longs up here, betting that it's possible that the spike has come to an end. And they're getting a chance to take profits at a relatively high price. So they're doing that. And that's what's causing 11 to trade below bar 10. And you got to think at least 80% chance that there's going to be buyers in some capacity below bar 10 within 3 to 5 bars during 11. Or not necessarily during 11, but within 3 to 5 bars. 12, a bull bar. It triggers the high 1 above 11, but you got to be, 11 is not really the best buy because it's a high 1, but it has a bear bar. It's still, it's still a bull trend. We're still always in long, so it doesn't make sense to sell above 11. It's the first bear bar in a lot of bars, so it's pretty scary to do that kind of thing. But again, it's not all that great to buy above 11 because it is a bear bar. So 12, an entry bar for the bears, for the bulls buying above 11, but not all that good. And then a surprise up on bar 13. 13, really big bull surprise. Bears were, traders know we're going to get a second leg up, but the question becomes, how deep is the pullback going to be? Are we going to go sideways first? What's it going to look like? And instead, we just get a breakout bar on 13 and the market gets stronger, trapping a lot of bears. Any bear who was selling the breakout point, betting this was going to convert into some sort of trading range, is now trapped. 14, consecutive bull bars closing near their highs. Where are we, what's the target here? Why are we doing this? Well, you know that the channel high, the 13 high, is a target, but we blow right through that on bar 14. I thought it was a pretty important target. Whenever you have a pretty important target and the market blows right through it, a lot of times it has to come back and test that target. And that might have been part of the reason we're doing this over here. But when we blow right through it, 13, 14 consecutive bull bars closing near their highs, where are we going? Well, the bulls who bought below, faded the breakout yesterday, they got trapped. And so it's possible that we're basically trying to get back to the bar 3 low from yesterday. And, the same kind of thing ended up happening over here for these traders. If they sold and, you're an algorithm and you scale in more 10, 20, whatever, 30 points higher, it came all the way back down and you were able to get out without a loss, basically at the end of the day. Obviously, as an individual trader, you're not going to do that. But it goes to show, that's a profitable strategy for algorithms, betting that, on the daily chart, this is not going to turn into a strong high 1 for the bulls. So even if they're selling here, they know they can sell more higher, sell more higher, sell more higher, and bet that we're going to get back to this price. So 13, 14 consecutive bull bars, always in long. It's really climactic, but there's nothing for the bears to sell here. There's no reason to be short. So all you can really do is buy. But again, it is definitely climactic. 15, follow through for the bulls. Again, same thing, climactic, but a lot of straight bull bars closing near their highs. So there's no reason to sell. 16, more straight bull bars. You'll notice that we have a bigger tail on 16, so it's possible we're going to be starting a channel pretty soon. 16 could be the start of the channel because tail on 16 pulls back and then reverses back up. So that could be the start of the bull channel. 17, more follow through. And again, you can see shrinking body. This is pretty ideal, to be honest. 14 and 15, the perfectly, amazingly ideal thing would be for there to be a lot less of a tail, a much, much smaller tail on the bottom of 14 and 15. So if they had basically like a one tick tail on the bottom of 14 and a one tick tail on the bottom of 15, that would be ideal. But you gotta love how uniform the size of these bars are. 14 and 15 are basically the exact same size as each other, which is what you want to see when you have a bull trend forming. You can see over here, we had 42 ideally would have been similar size to 41, or 41 would have been a little bit smaller and 42 would have been a little bit bigger, something like that. But even going up here, the move was climactic, but the bars themselves weren't huge and climactic until up here. So pretty healthy. This is pretty much a very healthy looking pair of bull bars, and you want to see that if you're a bull betting on the market going higher. And we have all these open gaps here. Let's see. And then, so anyways, 17, more follow through for the bulls, but a big tail on the bottom and tail on the bottom here, meaning a pullback is coming soon. Are you selling below 17? Nope. There's going to be buyers below. Very, very likely there's going to be buyers below 17. 18, an inside bar, a low one short for the bears, but it's we've had 4 bear closes and 18 bars today. No one is selling here. This is so strong. There's going to be buyers below. So bulls, they'll buy below 18, and we get a second leg up, possibly 19. You can see it gets back to the bar 17 close. So you buy the close 17, you add on more below 18, and you use 19 to sell out of your longs. 20, follow through for the bulls, but a big tail on the top and a tail on the bottom as well. So a little bit disappointing. And then an inside bar 21, but again, tails, so not as strong as it could be. Bears could argue it's a low too short for them, but it's really not very good. To me, this looks like we're starting the channel phase of this trend, and I'm not sure how much is left to it with how climactic and overbought this was. 22, a bear bar closing near its low. No one's selling though. If you shouldn't do anything below this. If you're long, probably makes sense to just get out down here. We're going to get back to the bar 21 low because the bulls who bought below 21, it's very unlikely that they're going to lose money. But still, if you had bought for any reason up in here, that's a different kind of trade. It's a limit order trade. So if you had bought for any reason up in here, it's probably fine to just get out below bar 22. Reversal up 23, but a bad high one at the bottom of the bull channel. It's probably not worth buying. A big bull bar 24, yeah, but 1, 2, 3 to me looks like a wedge. It's not worth buying. The close are buying above 24. I think, this does not look the same as the bull spike that we got from bar 4 to bar 10 or bar 13 to bar 17. Those look like a different thing. This looks like a buy climax towards the top of the bull channel. 25, a bear bar closing near its low. Am I selling below 25? Probably not. Again, this is probably going to start to go pretty sideways here. Yes, you could argue it's a wedge. We'll probably get 2 legs sideways to down, but at this point in the day, I don't really want to do anything as far as selling. I don't know if we've been traded above. What's the high? 88.5, 88.25, 88.25. So that's interesting. So rather than selling below 25, you can see the bears sold 1 tick above 25. They sold the high of 25 and they got filled, and that's where they made their money. So rather than on a stop order below 25, bears decided to enter on a limit order. Why? Because they sold above 18, they scaled in, they made money. They sold above 22, they scaled in, they made money. They sold above 25. What are they probably going to do? They're probably going to make money. And the opposite of that is the stop orders, right? The stop order bears, they sold below here and they immediately got trapped. They sold below here, they immediately got trapped. So bears are looking at 25 and thinking, I don't really want to sell below here. I want to sell above here because we've been selling above bars and making money, not selling below bars and making money. So that would be probably the reasoning for that, and one of the reasons why it didn't trigger. It's an inside pattern, 25, 26, but it's not really worth buying above. I think we're probably going to go pretty sideways here. If you're buying, you're hoping we get a breakout above this bull channel and another climactic spike. We've already had 2 of those, so I don't think it's going to happen. 27, follow through for the bulls, but again, sellers at that high. It seems like sellers up here. You were hoping 27 was going to be bigger and stronger. It's a bit disappointing. Buyers below 27 during 28 and rallied back up towards the 27 close. So if you bought the 27 close and you scaled in below 27, those traders got out around the 27 close during 29. And then 30, a huge bear bar closing near its low. 30 is a pretty interesting bar. It potentially changes the entire day. But it's very dependent on what bar 31 looks like. I think the thing to keep in mind at this point is that the daily chart is not all that bullish. So it's possible that this ends up being a bull trap and that we get a big sell off here. It's not all that likely, but it's going to be really dependent on what the next 2 or 3 bars look like. 30 is a huge bear bar closing near its low, and it's closing below the moving average. Bears are hoping we're going to do something like this, where we get a couple of huge bear bars here and a big bear surprise trigger below yesterday's low and keep selling off below the week. Below the midpoint of the week and potentially to the low of the week. And bulls are hoping basically to just stall the market and that the bears get bad follow through. And if the bulls can force bad follow through on bar 30, I think it dramatically reduces the chances of the bears getting a massive sell off. Because if they're going to get the sell off, it's probably going to start with a couple of very climactic looking bars. And instead, traders get a disappointing bar on bar 31. So that's really not what you wanted to see, because now, even if you get the bear bar, which you did 32, you're probably going to get bad follow through for that as well, because bears see the first spike and bad follow through. So the second one is probably going to be bad follow through as well. So as big and strong as this bear bar is, one, bear trends don't usually start with bars like 29. It's possible that this ends up being a signal bar and we trapped a bunch of bulls in, but you really need 31 to be a good follow through bar. And instead it's disappointing. So this might end up being some sort of trap, but 31 is not really worth buying after the bear surprise on 30. Even though, it wasn't as good for the bears as they wanted it to be, there's probably going to be buyers below, not too far below 31. So you can see on 32, we got buyers below 31. They're betting that this is going to be the second leg down, and this is all strong enough for a second leg up. Why is this all strong enough for a second leg up? Think about the higher time frame. Let's look at like a 30-minute chart. On a 30-minute chart, this is what this pullback looks like, right? So we got a ton of really strong bull bars. So this is going to get a second leg up. And the first reversal down here is probably going to be minor. So you have to think about it from that. This is the low of this ends up being bar 31, or during this bar is bar 31. So this is literally that pullback. And if you were trading this chart and you looked at all these bars, this is getting a second leg up. There's buyers below here within a couple of bars. Why is that important? Well, if there's buyers below here within a couple of bars, you can expect most likely you're going to get a second leg up from this spike within an hour or two, maybe 2 hours. Usually, I was surprised at how quickly the market reversed back up. I thought it would go sideways for longer, but a lot of times when you want the market to go sideways for longer, it will not end up doing so, and it'll just start to go anyways, like it did on 41 and 42. So 32, a bear bar closing near its low, could be a second leg trap. And if you sold below 32 and you saw 33, I think that's pretty disappointing. Another problem with selling below 32 is, 31 is a really big problem because it's not consecutive bear bars. So now you're selling, it could be a second leg trap, or you get one more leg down and then that's 3 legs down and then a reversal up. So even if we get back to the bar, the bar 10 high or 11 high, 12 high, that breakout point is not very far below, and there's going to be buyers there. So it's a bit disappointing. 31 is really disappointing, and 33 is also disappointing. The bears wanted a really big bear bar closing near its low. Instead, they got a doji. So bears buy back shorts. That causes 34, bull bar, but a big tail on the top. What do bulls want? Well, ideally, first off, what do bears want? Bears want to see this as a trend line break, and they want some sort of lower high major trend reversal and a big reversal down. What do bulls want? Bulls want potentially, even if we go sideways for a little bit, they want a really good looking signal bar, hopefully towards the bottom of the range to lead to a big bull trend. But a lot of times when you end up getting is when the bulls want the signal bar down here, bulls get eager and they start to front run the position, knowing that they have basically protection with how strong this was. So it's unlikely we're going to sell off. And so they'll start buying in here, and then it ends up just driving the market straight up rather than getting the deeper pullback. So 35 consecutive bull bars, second bull bar closing somewhat near its high, but not really worth buying. This is probably going to get 32, 33 is probably going to get some sort of second leg down in some capacity. You can see the bears who sold above 33, they scaled in higher. They made money on 37. So 36 trades below 35. There's going to be buyers below 35 and buyers at the 33 high. So buying below 35 was pretty logical, expecting at least another leg sideways to up. And you can just see what you get. 37, you can see buyers at the 33 high. So the bears who sold, they scaled in, they bought back their shorts. More likely, bulls, realizing some bears will buy back their shorts, are looking for any chance to get in the market at a better price, and they're buying into longs here. 38, a bull bar, but a big tail on the top. bears are hoping it's 2 legs up and they want some sort of lower high major trend reversal 39, but this is a really small pattern. Usually if you're going to get a lower high major trend reversal and you have, 27, 28 bar trend, you really want a bit of a deeper pullback and then a stronger signal bar. No one's selling below 39 as a lower high major trend reversal. They're wanting a much better looking bar. They wanted a bear signal bar that probably looked a lot more like 25, and they didn't need to get it here. We could have gone sideways more, and then they wanted just some sort of lower high after a couple legs sideways to up, and then a bigger bear bar closing near its low. I think for bears, it would have been better if this was leg 1, we got a pullback, and then a complex leg 2 up, and then a big bear bar closing near its low. I think that would have increased the chances for the bears to get some sort of move down. Instead, you get disappointing follow through 40, kind of expected because 439 is not a good signal bar. Bears are hoping this is a low 2 and that this is the start of a bear trend, basically in here, or the lower high major trend reversal, however you'd like to look at it. And I think the reality is it's probably neither, and this is probably forming a bull flag. 41, a bull bar closing near its high, breaking out above the low 2. So first measured move target is up here. I think the new high of the all-time high, it's obviously a target as well. It's up here. But we are back to always in long, clearly. Did we ever go always in short? I don't know, maybe very briefly, 30 or 32, but it was never very clear that we were always in short. But I think by the close of 41, we are back to clearly always in long, and you have a bull bar closing near its high. So always in long, bull bar closing near its high, reasonable to buy, bar 41. Consecutive bull bars, bar 42. We're probably going at least a little bit higher. We can get a strong breakout. If we can get a strong breakout above the high, this is the big question, I think, is what are we going to do when we get here? Why are we slowing down? Because although it's consecutive bull bars closing near their highs, we haven't tried to break out yet. So the breakout is going to be important. And sometimes you're going to get disappointing follow through here because the risk is relatively big. But okay to be long consecutive bull bars. 44, a bull bar closing somewhat near its high, and then you get a surprise breakout on 45. A tail on the top, so not as strong as it could be. The upside might be limited, but still no reason to sell. Lots of good bull bars closing near their highs. 46, an inside bar, a high 1 for the bulls. So we're still in the spike phase for the bulls. So you have a high 1 in the spike phase for the bulls on 46, which is going to be a reasonable buy as well. You can buy it, I don't know, stop below here, maybe, but I'd probably just buy smaller and put a stop down here and exit below bear bar closing near its low. And then instead you get follow through 47, 48. So more consecutive bull bars closing near their highs. It's reasonable to be long, reasonable to be buying. 49, another bull bar. We have big tails forming on these. Whenever you're buying really late in a trend, like if you're buying the close of 14, it's probably best to just look for 5 to 10 points and just get out. And I think over here, the same thing can apply if you're buying over here. Maybe 5 points, take a piece off at 5 points here. And then, I'd take the rest off around 10 points up here. I think that makes a lot of sense to do. Because a lot of times, if you don't scalp out with the 10 points, even if the market goes a little bit further, it's going to end up retracing back to further than where you would have exited with the 10 points. So even if, let's say, let's pretend you're really awesome at trading and you got out of a piece with 15 points, even if you got out of a piece with 10 points. Look at this. Actually, this is a better example. So if you bought above 46 and you exited with 10 points, during 51, you see 51 close on its high and you think, crap, I might have just missed out on a profit. And then you see 52 closing on its high and you think, oh, dang, I could have made 15 points, but instead I settled for 10. And then if you're trading always in, which is if you're not scalping out with these pieces, you're probably just trading always in. And then where are you going to exit then? You're going to exit below bear bar closing near its low. So you exit below 54 and you end up making 9 points. So it's reasonable to take these pieces off with scalps or, reasonably decent profit, especially considering the fact that you have no true risk on bar 46. It's reasonable to just exit these trades with, 10 points, 5 points, depending on the context. And like if I was buying above 14, I probably would have just looked for 5 points, to be honest. I don't know if that's the right thing to do, but that's what I would have. I think it's reasonable to just do that and you have no true risk, basically, and you just get out up here. Because the reality is you're probably going to, if you had just bought 14 and held, you get out below bar 22 and you only make 5, or you make, it says 5 points, but it's really, you have to make 5.5 points for it to go 5 points. So you'd make like 4.75 points if you just traded always in and exited below 22. So sometimes it just makes sense if you're buying late in the trend to scalp with, 5, 10 points, because you're going to get out better than you would have a lot of the time. But anyways, So very climactic move here. You can, again, take pieces off as you go. And obviously, really good looking pair of bull bars. A lot better than, basically since 41, 42, this is the best looking pair of bull bars. So when it looks better than the past 10 to 15 bars, it's probably very climactic. And you get a doji follow through bar in 53. Anyone who was buying the close of 52, well, there are two ways to buy the close of 52. Neither one of them you should do as an individual trader, but for algorithms, some of them buy and they have an uber wide stop. I don't know, maybe here, maybe here. And they're scaling into the trade, betting that even if it goes against them, 80% chance they can buy above a bull bar, even 55, and get out around break even. Here, they were not able to do that. So maybe they buy above 60. Oh, really interesting. Wow. So this is one of those very few times, 20% of the times, where if you bought above 51 and bought again above a bull bar here, or really anywhere, you were not able to get let out. So that might make this a bit more of a magnet if we start to rally again at some point. But the other way to manage it, the better probably way, is if you buy up here, you're hoping to see another bar that looks like 52. You want to see the market continue to race up, and you're basically buying up here hoping for one more climactic bar, and you can make 5 or 6 points, maybe 10 if you get lucky. And instead, you get a doji bar 53. So those traders just dump their longs around break even. This could be considered the second leg sideways stop on the tail of 54. So it's reasonable to think that this doesn't need to be retested. But I just think it's really interesting that the traders who bought here and scaled in were not able to get out without a loss. That's pretty rare, only 20% of the time. 54, a big bear bar closing near its low. Outside down, to me, this symbolizes probably the end of the trend. This has been really overdone, and we got past yesterday's high. So the question is, there's no way, there's almost no way. I say there's no way. Obviously, anything can happen. But if you're selling above this bar, there's almost no chance that you're going to get trapped pretty much immediately. So when we traded above the prior day's high and we blew right through it, you can see we never even, the traders on the 5-minute chart, it looked like they were getting trapped. And there's almost no chance that that was going to remain the case. So you had to be thinking we were probably going to pull back to this point later today. 55, a high one for the bulls. If you're buying it, you're scaling in lower. It's really not very good. You're buying far above the moving average, and we're probably going to get to the moving average. Additionally, 54 is going to get a second leg sideways to down. So buying above 55 and putting a stop below 55 is a recipe for disaster. If anything, just don't take the buy above 55 and just buy below 55 instead, and make a quick, I don't know, 5 points. You could probably make 5 points, I would imagine. Yeah. So if anything, you don't want to buy above this bar. You'd rather just buy below it. Disappointing follow through, 56. Relatively expected. Again, we're probably getting to at least the 54 low. We're getting a second leg sideways down from bar 54. 57, a bear bar closing near its low. Could be the start of the second leg sideways to down. 58, another bear bar. You can see 59 went to the moving average. So possibly a wedge, maybe 51, 53, 50, and 59 or 52, 54, 50, 59, something like that. But probably buyers down here. To me, this looks like 2 legs sideways to down, moving average. Does that mean buyers here in another huge rally? No, it just means probably going to start to go sideways. 60, a reversal up. You can see we haven't touched yesterday's high yet. So I do think we're going here. I think we're going to get back to this point. 60, a high 2 for the bulls. Probably sellers not too far above. Probably buyers not too far below. You can see it never triggered, and we went back to the bar 59 close, where bears bought back shorts and got a bounce on 61, or 62, a bull bar closing near its high. Not really worth buying above. I think we're probably just going to be in a trading range. 63, a doji bar, more follow through 64, but again, this is just looking like a tight trading range to me. 65, a bear bar closing near its low, and then a reversal up 66, possibly a wedge. So your wedge would be lower high, maybe lower high major trend reversals, your argument for 67. But I don't know, at this point in the day, I would just be done. We're getting support at the moving average. Doesn't mean we're going to keep getting support at the moving average, but bulls have bought at 60 and 66. I would rather just leave it alone. So 68, disappointing follow through. And 60, if you're selling here, I think if you're selling 67, it's, you might have to scale in, have a stop up here and scale in above this bar, but it's also difficult to do because we might go up here. It's not all that likely, but it's just nothing. None of the probabilities are all that good here. The argument for selling here is that the daily chart is way overbought and it doesn't make sense for us to keep rallying. And I think that's a credible thing to do. You could also sell here thinking we're going to get back to yesterday's high. I think that's a very credible thing to do, actually, because yesterday's high was such an important magnet, because it's very unlikely those bears will remain trapped. And you can see we ended up basically getting to it, and then we got a big surprise bar 73. bears see the big surprise on 73 and they see the tail as a pullback. So sometimes this happens. Let's look at like I don't know. Well, let's look at the whole thing, right? Let's look at like a 2-minute chart. But what I'm going to try and demonstrate basically is sometimes you see when the context makes sense for a sell-off, traders see the tail on 73 as a pullback and they sell the close of 73, trying to maybe get back and close this gap. So on like a 2-minute chart, might look a little bit different. So huge bear bar is a little more acceptable sell the close bar, right? Closing below its midpoint. So I don't know. To me, I think this is really difficult to get in on. Maybe you can sell below 74, but it's so late in the day and you're probably just done with the day. So if you did, good for you. You probably made money. You did a good job. And that was a reasonable thing to do. But I think it's just difficult to take that kind of trade that late in the day. For stop orders, 4 was a reasonable swing trade. I think 5 consecutive bull bars by the close, and it's by the close all the way through here. Obviously, very high probability of buyers below 10, maybe 80% chance. Maybe even a little higher. I don't know. If you're buying below 10 and you're willing to scale in, I mean, very likely you're going to make money. Buyers, so back to buy the close 13 could be climactic, but bull surprise, consecutive bull bars by the close, technically by the close, I suppose 17, but more of a doji bar. Looks like a wedge or some sort of channel starting to form, and it ended up being a wedge. I would not buy 26. This is a trading range to me now. Maybe you could sell 30 for a second, like sideways to down, but when we don't collapse, you probably just get out pretty quickly. You buy below 35 makes a lot of sense. Buy the close, inside bar high 1, buy the close. And we're probably getting back to yesterday's highs. So that would be your argument for selling in here. And then we got a big sell-off at the end of the day. So on the daily chart, disappointing follow through. You're expecting this to get a second leg sideways to down. Maybe there'll be buyers if we get that second leg sideways to down over here. Probably traders buying back shorts, I would imagine. Again, I still think we're getting here, but again, it's just going to probably be more sideways. I don't think this is going to keep being a bull trend. I think it's going to go sideways. The weekly chart, it's some follow through for the bulls for this big bull bar, but I don't really know how much is left to this. We're so far above the moving average. Think about it from your perspective. Do you want to buy this close when we're this far above the moving average? Not particularly. So you're probably getting back to the week of June 24th high, and I would imagine we're going to get somewhat of a pullback pretty soon here. Of course, it's possible we get another big bull bar next week, closing near its high, and we continue to rally, but bulls will need to do a pretty good job, make a pretty big statement if that's going to be the case. I think most likely we're going to end up going sideways. All right, that's the day.